still waiting for more people to? Why don't you have another go?
They need you on the map. Last year, no, but I think that, you know,
When Carell arrives, we start. There he is. Hello, hello. I'd like to welcome you to the last plenary session. And I have the pleasure of introducing Robert Boyer. The question is, or the questions are, how and why are economic problems transformed by storytelling? How do modes of regulation change? How do they stabilize? How might we imagine macroeconomic institutional histories as these reflect issues or topics such as wage relations, innovation systems, monetary and financial regimes, economic policies, and economic theories? These are the key questions for regulation theory, which now, of course, addresses itself to the issues arising from the crisis. Robert Boyer is one of the two most distinguished, I think, leading members who created regulation theory. He has had a long and distinguished career at the École Polytechnique, at Sciences Po, at the École des Ponts Paris-Tech, though I don't think it was called that then. No. What was it called then?
École nationale des beaux études.
C'est mieux ça, quand même. And now he's at the Institut des Amériques. He's the author of numerous publications, numerous highly cited publications, including A Theory of Regulation, somewhat similarly titled Regulation Theory. I wonder what your interest really is. Yes. And recently, Les financiers détruiront-ils le capitalisme? So I'm looking forward to the answer to that question.
Probably. The citizen does not wake up.
Okay.
Yes.
Anyway, it's with particular pleasure that I introduce Robert, who's going to talk about the unfulfilled promises of finance, but still the resilience of its power, a contemporary paradox. And you're going to talk for about 45 minutes, and you've asked me to be very firm with you about timing, so then we'll take questions in groups afterwards.
Thank you for your kind invitation. Let me introduce myself. Nobody's perfect. I'm a French microeconomist. So let me describe why you will be suffering in my presentation. I was trained as a mathematical economist. Then I made macroeconomic model for Minister of Finance. Then I fall in love with history of US and French capitalism, and along with Michel Agueta, we try to work out the concept of regulation. And recently I've been involved in two lines of research. The first one, why standard macroeconomics went so wrong. I'm going to show this. It kind of socio-political analysis of the transformation of macroeconomics. And second large interest, give my interpretation of the current economic world crisis. And I will mix them both, which explain the complexity. So if you don't understand anything, it's normal because I'm summarizing 20 papers. Okay. Let me try to start. What is the, I like titles which are self-sufficient. Finance is a world of promise. And the big drama today is all the promise have been broken. But what is very interesting, you go to the US, the Wall Street elite is still ruling and governing a lot of economic policy. And in Europe, the European Commission is trying to comply with the requirement of international investors. So in a sense, they still have the power. And for me, it is a paradox. And what I will try to develop is the following. First, what I like, we are living into a period of historical change. You see, equivalent to the interwar change. Why? First, I think even maybe British and American are not totally convinced, but finance-led growth regimes are over because you cannot cure excess of credit by excess of credit. Second element, which is very important, when I look at summit at local level, I realize that policymakers do not understand anything about the current crisis. Okay? It is very, very impressive. They seem to master it, but intellectually they are totally lost. And last but not least, you still have a wonderful conference of macroeconomics. Mathematical finance continues, but they were deadly wrong. So the fact is that the compass to guide policymakers are totally wrong, which is a part explanation. First, I think economics want to look like physics, and I will try to prove you that it was a false endeavor. Second failure, economics is about time, historical time and money. I will show you that conventional macroeconomics theory is unable to deal with time and money. So how to speak about finance if we don't have time, if we don't have money. Last but not least, in most macro models, you don't have finance. So when the financial crisis occurs, you have an empty box. It should not happen. And I will try to argue why. What is the content of my presentation? First part, we are living the idea of the dissolution of a great illusion. Really, just before the crisis, you take a wonderful paper by Olivier Branchard, a famous French economist, head of the economic department in the IMF. He said, oh, economic theory is nearly finished. We have only to work out the small details. Impressive, no? 3 months before the crisis, only the details, we all agree now. Perfect, okay. Second, why? It comes from the very after Second World War, general equilibrium theory, and I will try to argue why. So the crisis is much more severe than reactionary macroeconomics. This comes from the endeavor of the Coles Foundation, a very positivist way of doing economics, in which finance is vanishing. What is totally new in finance? You exchange promise of a capture of value in the future. This is a very complex good. This is very simple. Promise to pay tomorrow if it's a highly complex market and really normal conventional economic theory cannot deal. Then what I call in finance, you try to guess what will happen and to convince what you guess are the good ones. So I don't master well English, so I call it the divination term. We make all guess, and some of them are powerful than others, and some of the powerful are false. And then you have a breaking down of the crisis. So you see, to understand, clearly without the role of representation, you cannot understand the crisis. If you have a barter economy, I change this glass against this, well, it's never any crisis, no? Impossible. With I pay you tomorrow $100 million if I become inventor of a new economic theory, this is a promise, and of course anything would happen. Then I would like to argue that the lack of rigorous intellectual foundation play a dramatic role in the political debate. I'm amazed how implicit is the domination of this wrong theory. Then I will argue where does the power of finance come from? And I think I will come back to the famous, I was very inspired by Carol Williams during his 20 years ago, it was introducing me. And this, I think that if citizens do not wake up, financiers will break down capitalism. It is, I hope you will not have nightmares this night. Why should this invest? The economists, they are very proud. When physicists, because I belong to National Research Center, and physicists were among the commission selecting economists. Oh, this is real science. I recognize the maths. This is wonderful. So, natural science, you are real social scientists. Sociologists are not sure, but you are. Second, you export rational choice. Give me any problem, I give you the solution. By rational choice, wonderful, you have a wonderful tool. Third, since I'm the only scientific one, for example, you have rebellions in suburbs in Paris. Normally, government should call sociologists. No, they call the economists. Because the economists have the knowledge about the functioning of the society. But it's very interesting. Among social science, the economists are only entitled to advise the government. And last but not least, economists are terribly arrogant. They say the greed moderation is us. It's our theory. It has a new classical. It's us. It was not the Mr. Bill Gates. It's not workers. No. It's us. We created the ability to prosper. Wonderful. So you imagine the desire. First, I was holding a seminar in École des Études, and each September, I began with the following years. I took forecast of PCD made in June and in September exam. During nearly 20 years, it was always false. None of the recession was. So, and I said after the first session, if you come here to make good forecasts, you can go out of the seminar. I will never give you. So you don't think that we can predict. And unfortunately, American economists believe that the wonderful dynamic stochastic model, and German colleagues have been comparing. In black, you have the depression in the US. And all the line is the prediction of model. You have after collapse. No problem. Okay, we will survive. Okay, we will recover. At least the model, my friend, we recover. The theory is good. No, because they do not anticipate the double dip. And so you see, what is very impressive, you see this highly sophisticated model, it is a return to the mean growth of US economy, 3.3%. It's only, you have a huge complexity of maths. You return to the normal growth. You get Nobel Prize for having a return to the mean. So you imagine, it's impressive, it is high return investment. Second function of the model, I cannot forecast, but I understand everything. Let me take the example of multiplier. You take the same American data, the same one, and you are Keynesian, you are new classical, you are Ricardian, you get a positive multiplier of 1.6 or minus 0.3. And you understand why this is important, because if you have an austerity policy with Keynes, you exacerbate recession. With this theory, you compensate by private activity. Given the same data, you imagine this ambiguity. You don't know the sign of the evolution. You imagine the disarray of economy, and they are unable with economic study to align this. So they don't understand causality. I mean, what do economists do? Yes, and then they are totally unstable. This is how they multiply in normal times, and in depression, they are totally different. So you have the historicity of multiplier, whereas economists think we're physicists. No, whereas no natural law. In depression, of course, public spending is not efficient. You understand that you have regimes. You are lost. Your stability of model is totally lost. So what is left to economists, and I will do it please to you, you cannot forecast. You cannot understand causality. Therefore, what is the name of the game of economists? You invent words, you formalize, and then you understand the world you have been created. You will be very pleased. What is the professional economist? Models as economic fiction. They don't pretend to represent anything. You just play with concept, and in my world, American economy should function accordingly. It is a wonderful job because everybody can imagine. So you can even read economic American economy, they are economic fiction. So You invent a word, and you are very easy with it, because you invented it, and then you are not surprised. But any relation with existing fact is contingent. First of the first man. Why such a huge error? Because it comes from very, very, very early. My initial training was in general equilibrium theory à la De Breu, à Kahn, à Rome. Very few people understand this theory. De facto, it is a purely barter economy. In the sense, you are exchanging each time, you have a planner, and at any moment you exchange a series of goods against another series of goods. Second element, you need very, very drastic conditions for this equilibrium to exist. Absence of equilibrium currents, no contamination of efficiency by equity, no public goods, no innovation. And last but not least, at the equilibrium, there is no money. So imagine this kind of model. It was impossible to introduce in this framework money. And if you don't have money, you imagine that you don't have finance. Second element, what to do? So no theory of money. At the equilibrium, you don't have any stock of money. Second element, what to do with the future? We open a total set of contingent market. Tomorrow, if I earn the lottery 1 million, I buy a Toyota, I go in Florida. So you have all contingent markets, which really, and I'm so clever that when I'm born, I am planning my lifelong story. And only history is purely innovation, stock, which realize my future plans. In a sense, today, all the history is set by the fact of the contingent. And of course, if you don't have money, you can have any crisis by definition, because you have to exchange labor against goods. So by definition, you are totally lost. And you are obliged to say, in my model, there is no crisis. Therefore, there is some. We should deregulate. We should decentralize. We should open the market. We should have market flexibility. Because in my model, I have no unemployment. So I don't know what is transfer. So you understand the normativity. So the charm of theory is presented as highly positivist. We are positivist. No. De facto, we are comparing their model to the reality, and the reality is totally imperfect. For example, I'm amazed when in Spain, you say, oh, what a market rigidity. And the drama is that your workers in the construction industry, it is very difficult to compare them in high-tech engineers. You say, for what is called labor market flexibility, especially the specificity of competence, which are not linked to any market rigidity. Then, what is very interesting is that how to interpret employment? Simply, the crazy model we gave the Nobel Prize to Lucas and others, unemployment is voluntary. Make a survey in Europe, because the wage was so low, like I prefer to go leisurely. This is embedded in, for example, the European Central model. It's not unemployment. Simply the people withdraw from the labor market, which is totally Keynesian. No credit, no stock market, and what is very impressive is more that you are so clever that you never get bankrupt. Because since you optimize, it's very bad to go bankrupt. So you prevent bankruptcy. So wonderful. Imagine Lehman Brothers cannot exist because they are so clever that they don't want to be bankrupt. And since our rational expectation, so you imagine when you have a bankruptcy, it negates the model totally. And therefore, last, then you still have the free man helicopter. Imagine that Obama should be able to send Mr. Bernanke with dollars all over US. Everybody will be happy. Because on the pavement, they take the money and they go to the butcher, to the supermarket. Dramatically, they get to the bank. And the bank decided to buy treasury bond. And the credit is missing. But in the theory, it should be given to the money. So you understand intellectually the bankruptcy. Why you have so much money? To say, there is no helicopter. The money go to the bank. And in the macro model, you don't have any bank. I'm so amazed and ashamed because my profession is macroeconomist. How could a profession become so silly? So, last, mathematical finance. Wonderful. What impressed me is that you have an entry of Russian, Indians, French, because you need to be very detailed in mathematics. You are non-economists able to play the game. You need to be a specialist of static process. Therefore, nobody is perfect. If you know stochastic process, you don't know finance. And then you are consulting you invent pricing, and you make a Gaussian hypothesis because you learn from statistics that good statistical processes are Gaussian. Unfortunately, as Benoit Bendelbrot demonstrated, Gaussian law is, for example, for Alain Griezmann declared the crisis of Lehman Brothers should happen only once every 3 centuries. No, because they have this law. If you have this student law, no, it happens every 7 years. So you see again the error. They pretend to be scientific, but as you see clearly, the distribution is not this one. So the crisis was totally forecasted. The pricing was, my best example is AIG. They designed a wonderful credit default swap with totally false probability. Then the risk happened, they go bankrupt because they used this and it was this. So many people neglect the fact. And why they did accept? Because they earned a lot of money. And then, this is my favorite, oh, what is this strange? And what is very impressive that, for example, I learned, for example, a good forecast with my friend, Mario and Dominique Pillon, that the next crisis in 2003 would be derivatives because they've been ready the Bank of International Settlement. But the people in Wall Street, no, what a surprise. They've been creating the mess. So you see again why finance has been intoxicating itself by the false scientificity. Okay, it might be a detail, but okay, so complete disarray of quants, macroeconomists and governments, really, they have lost their intellectual compass. And therefore, it is very difficult. When you are in crisis, you don't know how to analyze the situation. So you go from one to another one, you do ideology and so on. Third, why finance is so interesting? Because by definition, you are open to radical uncertainty. And radical uncertainty is really very important. But economists are very weak in methodology and epistemology. For them, when they observe the market of treasury bonds in the US, it is a perfect market. You have a computing system, at any moment, you have a price. This is a perfect market. Yes, but what is very, and they say, Van Raas was imagining to extrapolate the stock market to the world economy. The drama is that you have a price, but nobody knows the value of the good being transacted. And as studies are shown, when you have a dependency of price upon quality, the market cannot function. So the big drama is the following. You have the illusion of a perfect price of market, but the good being exchanged is totally different from the normal goods. And of course, why it's very interesting is the following. Let's take the example of the stock market. You have, imagine that you keep for eternity the security of a company. It was a proposal by Boris Saleh. Then, by definition, the only name of the game is to find the fundamental value. But imagine now you have a very liquid market. At any moment you can exchange. You will compare your fundamental value with the price of the market. Imagine now that you have an increasing uncertainty. For example, I will give an example. For me, Facebook is valued at 0. Okay, but I observe the price. Some people seem to favor $30. Good. You have uncertainty. The more the price go to $30, I adjust my own feeling to the feeling of the market. And what is very interesting, if I know nothing, I imagine that other people are clever than I. Somebody might have an information. Insider trading will reveal something. And then my friend André Hollard wrote a wonderful model in which if you have a small variance, this is the probability of the value, and you have a tax with no dividend. Wonderful. You have the fundamental value. Perfect. Now you increase a little bit the volatility, the variance. You have a widening. This is the normal statistical way. But up to a threshold, you have the following bifurcation. You have only the pessimist view, optimist view, and the more uncertainty, the more you go to an extreme valuation. Therefore, in financial markets, since it is rational to be mimetic, you have the following paradox. At any moment, you have a precise and real valuation. of evaluation which is generally erroneous. So you understand the trick. You have evaluation, but you don't know what you are. And second element, if you have a highly liquid market, at any moment I can sell and buy. I don't care about fundamental value. Therefore, the more liquid the market, the more will be frequent speculation over the valuation of enterprise. And it's exactly what is happening with financial liberalization. And you should remember John Maynard Keynes looking at the stock market in the US. It looks more like a casino game than an efficient allocation of capital. So, because by definition, you are losing any reference with the long-run value of the time. And what is very interesting, you have the famous diagram by Robert Shiller. In dark, you have the stock market valuation in US from the early, mid-19th century. And all of their values are estimated value with perfect forecast of dividends, of rate of return, time preference. As you might observe, in contemporary value, you have always undervaluation, overvaluation, undervaluation, overvaluation. So the market has been in equilibrium very rarely. So you have endogenous the formation of bubbles, which is a very interesting reason. You have, because the idea of you converge rapidly toward the true value. You are never on the fundamental, and you need decades in order to converge this value. So in a sense, you are organizing a systematic misallocation of capital via financial markets, which is very legal. And this explains why you need convention, because you are so lost that, for example, I'll give you an example. When the Siller Fall was introduced in France, the implicit price was avenue. People buying, say, I will put in my earning evaluation, but you will give me 4,000 francs of intertemporal return. So just as a convention, it was an invention. For example, startup value of the Silicon Valley will replace Detroit. Or third, invest in the bricks. Okay, so you need to simplify the situation, and then everybody is guided by this convention, and the market is nearly stabilized. But they are totally social construction. This is the point. They do not represent fundamental valuation. And of course, you understand that if you don't have, for example, in the time of segmented finance, regulated control, any rumor is triggering an evolution. Let me give a contemporary example. You have a open summit. The day afterward, the euro is skewed. 2 days later, no, the plan does not function. And you alternate from this position. It is impressive. The inability of financial markets. So, and they repeat. So the idea that in the long run you learn. No, they don't learn. It's systematic. The euro is skewed. The rest. But why? Because society is unable to enforce the convention. Since the head of state are unable to tell the convincing story, the market go along its own way. So you understand? You understand better my part on the power of finance. Let me turn to why it is so important to have a divination term. Why? Because everybody now is against rational expectation. First, it supposes that you have an incredibility of computation superior than the computer are launching the shuttle toward Mars, because you have a huge amount, you have to compute the optimal strategy of 7 billion persons over their lifelong and their interaction. This computer does not exist. Second, impressive Mr. Ben Bernanke say he does not know the consequence of his policy on macroeconomic evolution of US. But in Chicago, we think that the housewife in Detroit knows this. So it is wonderful. The expert don't know the model. It's called model uncertainty in the language of central bankers. But citizens know. So last but not the least, imagine you have a paradigm shift in technology, in innovation. By definition, the system is not stable. It is a non-ergodic. And in this case, rational expectations are totally false, because you don't reproduce the past, you open a new period. Second challenge of this case has been totally forgotten, because now Minsky has been coming back. Keynes, not so much. He has been saying, fasting uncertainty we cannot make any rational computation. So it was in this one, we have a kind of will, of belief. We are awake and we are optimists. I invest in this. I wake up, I feel bad. I don't invest. So it's part of total impressionistic analysis because I cannot make the full rational computation. And therefore, the only way is to follow a kind of convention. And if you look carefully, Robert Schiller and Karloff say we should restore the concept of animal spirit. But what I don't like so much is to say pseudo-concept, not powerful enough to replace, because it's simply what thinks an investor is what is actually occurring. It is a kind of tautological, what rational expectations are supposed to be much more predictive in terms. Therefore, storytelling becomes the name of the game. Because since nobody knows, for example, Facebook, you have to sell a complete new story, no? Because it's unprecedented. And therefore, I was impressed by that. Story selling, okay, much more than telling, no? Is the name for financier. Nobody knows. Therefore, I will tell you a story, and it is a huge simplification of a complex interdetermination. And since politicians hate complexity, they buy simple story, and the simplest, the better, because then I can understand it. And what is very, very, very interesting, then by definition you have a conflict of representation. And what is interesting too, I was very impressed by, I missed the presentation by Jens Becker yesterday. I think you need for forecasting the price of oil, you need to forecast, will you have a war against Iran and so on. You need a world story, no? And will I buy a flat and so on? You need to tell a story just to be able to form the price. So it's not a kind of, you have the basic price of oil and then you add a little story. The story makes the price, especially with the existence of future markets. And therefore, which is very important, you need fictions just to understand what is happening. Last but not least, my friend André Orléans has published a very influential book named the Empire of Value, in the sense that what is observed for finance can be observed for many other goods. For example, if a Volkswagen is not equal to a Peugeot, it is because you have a construction that it is Dutch quality. So in a sense, it's trying to apply the construction of the quality of goods from finance to other products. And this changes totally the value theory, in the sense you have a constructivism or a content of even in the simplest good. Oh yes, the most wonderful example, if you buy a bottle of Evian, the price is 10 times the price of the tap water. And the quality, see, you understand the construction of the image, no? It's the point of André Orléans. If you can retrench, you should really be this. I'm not totally convinced, because I think finance are specific, okay? But it is an interesting way to extend a new theory of value. And why crises happen? Broken promise. And what is in this framework, and it is the basic inspiration of regulation, the crisis should be very frequent, because accumulation is contradictory. So for us, the surprise of Fordism, contrary to crisis, we are not functionalists at all. We were surprised of the stability of Fordism, because for us, the crisis was permanent. In this case, why you have such many crises? Because this invention, you hardly have self-fulfilling prophecy, because the world is too complex. Therefore, by definition, you have unfulfilled promise, and the crises are. For example, you have the internet crisis. What happened to it? Simply, they think that during 7 years, you get the impact of a technological revolution, which will take 3 decades. You say, okay, you were right. It might be revolutionary, but the time scale is not the good one. The subprime crisis. The promise by Bush was the fact we don't have welfare, but we have credit. So go to university by credit, buy your house. So alleviate poverty by pure financial innovation. And many people have been believing, for example, the Socialist Party in France want to introduce the universal prime. So you understand the attractiveness of this. Okay, if we can solve by credit, why not to try it? So you understand that anybody can be tempted. Then why to study this? Because you have drastic consequences. What bothers me is that when you study finance, you should have anti-cyclical finance. In the boom, firms don't need so much credit. They need it in the recession. But with the myopic evaluation, I'm in good shape, I will profit. In market-led economies, like the US, you have pro-cyclicity. So in good period, you give credit to anybody. In bad period, even good entrepreneurs don't get credit. It's the drama of Obama. So the inversion of small size are not taken because the credit is pro-cyclical. Whereas in normal neoclassical theory, it should be totally anti-cyclical. Last, I'm studying a lot of Latin American countries. Argentina,
15 minutes.
15? I will then time. Seen from Wall Street, the rest of the world looks alike. And then you have the following idea. When the traders in Wall Street are optimistic, they're optimistic for all over the world. Let's take the example. You have junk bonds in the US after the internet collapse. Immediately, they repercutate on Brazil and Turkey, without any new event in Brazil. So see what is interesting, you have a huge asymmetry. An event in Brazil does not affect Wall Street, but a movement in Wall Street affects Brazil, without any change. So you understand this asymmetry, which is really impressive, in the sense you have moods wave of optimism, and they diffuse all over the rest of the system. Then you have the following. Most of my friends fall in love with the concept of emerging economy. But this concept was coined by Goldman Sachs that want to penetrate the markets with high profits. So it was not an intellectual concept. It was a practical concept. Let me open the financial market. I want to make profit along with you. And all my friends took as a wonderful concept. Emerging, and what is very frightening for me, they have been confusing a rentier economy with a peripheral capitalist based on natural resources, a continental economy. So what is very impressive, instead of screening these countries, have been mixed in the same bulk, whereas Russia has nothing to see with the rest. So you have a kind of huge